Dividends remain one of the primary ways smart investors earn passive income on either a monthly, quarterly, or annual basis. Dividends serve as a way to reward pre-existing investors and to recruit new investors to lend them their capital. Depending on a dividend's yield, this may serve as insight into whether a company is about to take off or a company that is in trouble. There are a few very important factors when thinking about investing into high dividend paying companies, all of which we'll talk about in this video. I'm going to be going over 5 of the most stable, high paying dividend companies that have time and time again proved and valued their investors by paying out dividends and recruiting new investors to continue lending them their capital. In a world where high dividend paying companies are becoming increasingly rare, you'll find that these companies remain some of the very few left who truly value their investors by paying out huge sums of their earnings on a continual and increasing basis. What is up, you guys? It's Nick back at it again with another video. If you haven't already, hit that subscribe button. I would really appreciate it. I do a ton of videos like this going over passive income ideas, tech stocks, IPOs, electric vehicle stocks, anything and everything personal finance to keep you ahead of the curve. While you're at it down there clicking things, decimate that like button. I would really appreciate it. It helps out so much with the YouTube algorithm. It helps spread the video to more and more investors, which is good news for us collective investors. All right, without further ado, let's get right into it. The first company I want to talk about is one of my utmost favorite high-paying dividend companies I have ever invested in. This is a company that has been around for 171 years. You could say they have a bit of experience under their belt. Founded in 1849 in Brooklyn, New York, Pfizer remains one of the biggest pharmaceutical giants in the world. It is listed on the Fortune 500 by total revenue, having generated almost $52 billion just last year alone. If we're doing math here, that's $1 billion a week. Pfizer is a giant pharmaceutical company and genuinely one of the most diversified pharma companies out there. If you are trying to gain exposure to the healthcare sector, the biopharm sector, the biotechnology sector, Pfizer is definitely your top choice. They have their hands in very relevant current vaccines considering the health situation we are in. They're designing state-of-the-art drugs, cancer therapies, antibiotics. They are performing clinical trials. The list is virtually endless and is literally overwhelming. Going into their balance sheet, Pfizer has an enormous market cap of $203 billion. They have an incredibly low beta value of 0.66, showing extreme stability in a very tumultuous market. They have a relatively low PE of 14 and a respectable earnings per share of 2.53. But here we go. Amidst this massive company, they continue to truly and highly value their investors by paying out a dividend yield of 4.12%. This is really incredible in today's day and age. Going to their dividend payout history, it's clear that on an annual basis, Pfizer continues to increase its dividend payout, which typically hovers around the high 3s and low 4s. With a lot of capital gains to be made with this company in the coming years, with healthcare being an increased importance in many people's lives, biotech becoming an increased importance, healthcare, and especially antivirals, Pfizer remains one of my favorite companies, especially when considering this extremely high and consistent, reliable dividend payout. All right, moving right along. This next company pays out one of the highest, most stable dividend payouts going right now. They're down almost 40% in the past 5 years alone, making it a very good time to get in for future capital gains while receiving a very juicy dividend. The company I'm talking about is British American Tobacco. This is a company founded in 1902, over 100 years ago in London, UK. Again, keeping with the theme and the concept that older companies have seen it all, have great management, typically have massive market caps, and most importantly, have time and time again adapted to shifting markets and shifting economies and are extremely diversified. British American Tobacco are a cigarette manufacturing company listed under ticker symbol BTI. They have an extremely low beta of 0.57, showing much less movement than the overall market. They have a very low PE of 1.53, a phenomenal EPS of 22.16, and here we go. BTI pays out a dividend of 7.81%. This by itself would be a very reasonable and respectable gain over the course of the calendar year, and considering they're at all-time lows, compounded with the capital gains you may be able to receive, this is a phenomenal buy. They sit at a 1.7 in between a strong buy and a buy, and have an analyst price target much above their current price. They have an extremely solid balance sheet with a return on equity of 9.62%, a profit margin of 24.43%, generated $25 billion in 2019, and $21 billion of that was gross profit. It's a good business to be in. I have done a lot of research on this company, and regardless of your stance on cigarettes and tobacco, BTI remains a great dividend paying company and an extremely solid long-term investment. All right, moving right along. The next company you've probably all heard of. They are an absolute powerhouse in the telecommunications sector. They've been around since 1983. They're a multinational conglomerate holding company. In 2019 alone, they generated $181 billion. The company I'm talking about is AT&T. We are all familiar with AT&T, and you might have strong feelings about this company, but there is no denying their balance sheet and their current and future business operations. They have been quietly diversifying their company for the past 3 decades. They have their hands in everything and essentially own a stake in every single major telecoms company, fueling their bottom line. AT&T is a large cap company with a market cap of $195 billion. They have a very low beta of 0.65, showing extreme stability. Are you seeing a trend here yet? They have a relatively low PE of 16.74 and an earnings per share of 1.64. Here we go. AT&T, even being a massive company, pays out a dividend over 7%, 7.57%. Just like other companies I've previously listed, AT&T is trading at incredibly low rates when compared to historical prices. They are down almost 30% since earlier this year, making it a great time and price to pick up some additional shares at a sale price. It does indeed look like they may be finally bottoming out and hitting its support line around the $26 to $27 price point. Along with this nice dividend yield, analysts are predicting an average price target above their current price. AT&T has consistently increased their dividends on an annual basis, even through the recent turmoil. This shows that they value their pre-existing investors and keeping their word that they are a dividend aristocrat and here for the future. If they can make it through this year without decreasing dividends, there is virtually nothing that will do so. All right, next to a company with a less powerful dividend yield, however, still very respectable in our current climate. However, what makes this next company very interesting is the promise of pairing this dividend yield with the massive capital gains this company could see. This company I'm talking about is Medifast, a nutritional and weight loss program company founded in Maryland in 1980. They are a small cap company with $1.91 billion market cap, a somewhat high PE of 25, a beta value of 1.20, and an earnings per share of 6.39. They pay out a very respectable dividend of 2.82%. And now here's what makes this company so interesting. They are expected to grow earnings 20% annually over the next 5 years. This is really incredible, and in today's climate, this company shows so much future promise. I do think this company will return to a better entry price point, and I will personally buy additional shares if it hits the 150 mark. They have seen an over 200% increase in share price since March lows and could be a very strategic play for your investment portfolio moving forward. They have beat earnings the past 3 quarters and are a very undervalued company at the moment. They continue to exponentially grow their revenue every quarter, and with that, their earnings. They have a price target well above their current price, which makes it an opportune time to buy into this company. As nutrition and healthy weight loss become an increasingly important part to many people's lives, this company will continue to grow and help people. They are very well positioned for the coming landscape, and with the dual-pronged approach of high dividend payout yields paired with high capital gain potential, this company is a strong buy for me. This last company is a much more speculative buy. It is a much more of a gamble than the previous 4 investments. However, this could could play out huge in the long term. I do want to make it clear that these first 4 companies, and especially the first 3 companies, remain very stable, relatively secure places for your capital to grow long term. However, this last company is more high on the risk reward scale. The company I am talking about is Energy Transfer under ticker symbol ET. Energy Transfer is actually an MLP, which is akin to a real estate investment trust. MLPs are able to secure tax breaks and instead pass on these earnings to their investors, relaying into incredibly high dividend yields. I'm not sure you'll believe me when I say this, but Energy Transfer's dividend yield is 19.40%. Although this yield may see a cutback in the coming quarters, I do think Energy Transfer could play out huge in the long term. The goal here is to get into this company at a very low share price, run out the turmoil in the short term to gain heavily from long-term gains. The energy sector has been one of the most brutally hit sectors this year, and investors have run for the doors. It is a speculative play in that analysts aren't quite sure what's going to become of the energy sector moving forward. Analysts place ET at a 2, which is a buy, and have an average price target almost 100% above its current price. There is a ton of upside to this company. However, a lot of factors have to fall into place, and a lot of things have to go right for this play to work out long term. Anyways, guys, thanks so much for watching. Those are my 5 high-paying dividend yield picks. I hope you like them. I've put a lot of thought and research into each one of these picks. It's not like I just pulled them out of thin air. Having said that, make sure to do your own due diligence whenever choosing and picking stocks. Gain as much analysis and research into each company that you are choosing to buy before actually pulling the trigger and doing so. Don't just take my word for it because I'm saying it on the internet. Do your own due diligence. It is so important for you to do that as an investor. Anyways, thanks so much for watching. If you haven't already, hit that subscribe button. I do a ton of videos like this and I would really appreciate it. While you're down there clicking things, absolutely smash that like button. It would mean a lot to me. It helps out the channel, helps out with the video. Anyways, guys, I'll see you in the next one. Cheers.